Welcome to SS2 Economics, Term 1, Week 6. Today we study fiscal policy, the use of government expenditure and taxation to influence the level of economic activity, control inflation, reduce unemployment, and promote economic growth. Fiscal policy is one of the two main tools of macroeconomic management. The other is monetary policy, which we will study next week. In Nigeria, fiscal policy is managed by the Federal Ministry of Finance, the Budget Office of the Federation, and the National Assembly, which must approve the national budget. Understanding fiscal policy is essential for any Nigerian citizen seeking to understand why the government raises or lowers taxes, why it borrows money, and how these decisions affect jobs, prices, and living standards. Government expenditure consists of all spending by the government on goods and services, transfer payments, and debt service. Recurrent expenditure covers the day-to-day running of government, salaries and wages of civil servants and teachers, purchase of drugs and medical supplies, maintenance of roads and buildings, and interest payments on government debt. Capital expenditure covers investments in long-lived assets, construction of new roads, bridges, hospitals, schools, power stations, and government buildings. Transfer payments are payments by the government to individuals that are not in exchange for current production, pensions, student bursaries, and social safety net programs. These transfer payments do not directly create output, but they put income into the hands of households who then spend it, raising aggregate demand. In the Nigerian federal budget, the largest items of recurrent expenditure are debt service, interest on Nigeria's large domestic and foreign debt, salaries of government workers, and statutory transfers to the National Judicial Council, Federal Capital Territory Administration, and other bodies. Capital expenditure has historically been underfunded due to revenue constraints and was chronically below 30% of total expenditure. Taxes are compulsory payments made by individuals and businesses to the government without a direct return of specific services. Taxes serve several purposes. They raise revenue to finance government expenditure, they redistribute income from the rich to the poor, they correct market failures such as pollution, through environmental taxes, and they influence aggregate demand, reducing consumption through higher income taxes during inflation. Types of taxes in Nigeria. Direct taxes are levied on income and wealth. Personal income tax (PIT) is administered by state governments for individuals. Companies income tax (CIT) at 30% is levied by the Federal Inland Revenue Service (FIRS) on company profits. Capital gains tax is levied on profits from selling assets. Indirect taxes are levied on spending. Value-added tax (VAT) at 7.5% is levied on goods and services at every stage of production. Customs duties are levied on imports. Excise duties are levied on domestically produced goods such as tobacco and alcohol. Petroleum profits tax is levied on oil companies. A progressive tax takes a higher percentage as income rises. PIT is progressive, 0% on the first 300,000 naira, rising through bands to 24% above 3.2 million naira. A proportional tax takes the same percentage regardless of income. A regressive tax takes a higher percentage from lower income earners. VAT is often considered regressive because poor households spend a higher share of income on vetable goods. Fiscal policy can be expansionary, stimulating, or contractionary, restrictive. Expansionary fiscal policy is used during a recession or when unemployment is high. The government increases spending, reduces taxes, or both. Increased spending raises aggregate demand directly. G rises in Y equals C plus I plus G plus net exports. Reduced taxes increase household disposable income, raising consumption. The effect is amplified by the multiplier. A 1 billion naira increase in government spending raises national income by the multiplier times 1 billion naira. Expansionary fiscal policy increases the budget deficit. Government spends more than it collects in taxes. Nigeria used expansionary fiscal policy during the 2016 recession, when oil prices crashed, and the 2020 COVID-19 recession, running large deficits and borrowing heavily to maintain spending. Contractionary fiscal policy is used during an inflationary boom to reduce aggregate demand. The government decreases spending, raises taxes, or both. This reduces aggregate demand, cooling inflation. Nigeria used contractionary fiscal policy in response to fuel subsidy reform, 2023, and exchange rate unification, which aimed to reduce government losses and fiscal imbalances. The government budget is an annual statement of expected revenues and expenditures. A budget surplus occurs when revenues exceed expenditures, the government is saving. A budget deficit occurs when expenditures exceed revenues, the government is borrowing. The Nigerian federal government has run persistent budget deficits for many years, driven by high recurrent expenditure and revenue shortfalls when oil prices fall. Nigeria's fiscal rule limits the budget deficit to 3% of GDP, but this limit has been regularly breached. Government borrowing to finance deficits adds to the public debt, the total stock of outstanding government borrowings. Nigeria's public debt rose sharply in the 2010s and 2020s, both domestically, FGN bonds and treasury bills administered by the Debt Management Office, DMO, and externally, Eurobonds and loans from World Bank, African Development Bank, Chinese Exim Bank. By 2024, debt service, interest payments plus principal repayments, consumed over 70% of federal government revenue, severely limiting spending on development. The Debt Management Office, DMO, manages Nigeria's debt portfolio and issues new government securities. To summarize, fiscal policy is the use of government expenditure and taxation to manage aggregate demand. Government expenditure includes recurrent spending, capital investments, and transfer payments. Taxes include direct taxes, PIT, CIT, CGT, and indirect taxes, VAT at 7.5%, customs duties, excise duties. Progressive taxes take a higher percentage as income rises, PIT. Regressive taxes like VAT take a higher percentage from lower income earners. Expansionary fiscal policy, more spending, less tax, is used during recessions. Contractionary policy, less spending, more tax, is used to fight inflation. Budget deficit equals government spending minus revenue. Persistent deficits create public debt, which creates debt service obligations. Nigeria's DMO manages public debt. For WAEC, define fiscal policy, distinguish direct and indirect taxes, progressive and regressive taxes, explain expansionary and contractionary policy with examples, and explain the relationship between budget deficit and public debt.